Welcome back to The Explainer. If you're gearing up for that Florida general contractor exam, you already know that swinging a hammer and actually managing a job site is, well, it's really only half the battle. Today, we're diving into a massive domain of your exam, conducting accounting functions. Look at the syllabus and you'll see this single section makes up a staggering 32% of your entire exam weight. So yeah, it's a huge deal. It is absolutely your financial blueprint for passing the test, and honestly, for keeping your future business alive and kicking.
Give us about 10 minutes and we're going to knock out 4 crucial, highly testable topics. We'll hit core financial statements, critical financial ratios, revenue recognition methods, and finally, we'll wrap up by mastering the WIP schedule.
Let's kick things off right now with Section 1, Core Financial Statements.
Okay, so every successful contractor and definitely every test taker needs to know their core financial documents inside and out. Think of the balance sheet like a photograph. It's a highly specific snapshot, literally frozen in time, that tests your solvency on one exact day. Sureties and banks, they look at this snapshot to see if you have the resources to pay your bills right now, today. The income statement, on the other hand, which you probably know as your P&L or profit and loss, is more like a moving movie. It shows your profitability in motion over a chunk of time, like a month or a full year. Lenders watch this movie to figure out if you can sustainably run a profitable business over the long haul. Here are the big 3 statements and the exact no exceptions accounting equations you've got to have memorized for exam day. For the balance sheet, the formula is assets, which is everything you own, must equal liabilities, which is everything you owe, plus owner's equity. Simple enough, right? Now, for your income statement, it's just revenue minus expenses equals net income. Basically, what came in minus what went out equals your profit. And finally, your cash flow statement. It does exactly what it says on the tin. It strictly tracks the actual movement of cash in and cash out of the business. You need this because, let's be real, you can easily show a paper profit on your income statement but still have literally zero cash in the bank to make payroll on Friday. You absolutely have to know these 3 formulas cold.
Moving right along to Section 2, Calculating Critical Financial Ratios.
So now we take those numbers from the financial statements and use them to measure the actual mathematical health of your business. To figure out your company's liquidity and leverage, you need the current ratio, the quick ratio, debt to equity, and working capital. Now listen up, because here's a massive exam tip. Test writers absolutely love using alternate names just to trip you up. They want to see if you actually understand the concept, not just if you memorized a flashcard. So they will frequently call the quick ratio the acid test or the net quick. If you see those on test day, don't panic, it's just the quick ratio. We also have debt to equity, which measures how much you rely on borrowed money, and working capital. Working capital is just your current assets minus your current liabilities. It's the actual raw dollars you have left to work with.
Knowing the formulas is great, but knowing your target goals, that's the real meat of the exam. Take the current ratio, which you get by dividing current assets by current liabilities. Your target here is a healthy 2 to 1 or even higher. If that ratio starts dipping below 2 to 1, I guarantee you, banks and sureties are going to start getting extremely nervous. A 2 to 1 ratio proves to them that for every single dollar you owe in short-term debt, you've got $2 sitting in the bank or in liquid assets to safely cover it.
But if you use the quick ratio, the whole game changes. The quick ratio is a much stricter test of immediate liquidity because you completely strip out your inventory and your prepaid expenses from the math. And why do we do that? Well, because you can't exactly pay your crew on Friday with a giant stack of 2x4s sitting out in the lumber yard. And you sure can't cash in a prepaid insurance premium to pay off a subcontractor. Because this test is so much stricter, your target goal drops to a solid 1 to 1. One truly liquid, spendable dollar for every single dollar you owe.
All right, let's jump into Section 3, Revenue Recognition Methods.
Put simply, these are just the accounting rules that tell you how and when you are officially allowed to count your money on the books. You've got to know the difference between the 2 main methods here. The completed contract method, or CCM, says you only recognize revenue and expenses when the project is substantially totally complete. Now, this is great for deferring taxes, but think about what it does to your financial statements. You could be working on a massive project for 11 straight months showing 0 revenue, and then bam, month 12 shows this huge spike in income. It creates super lumpy financial results. That is exactly why banks and sureties heavily prefer the percentage of completion method, or PCM. PCM smooths all that out by recognizing revenue over time based on your actual progress on the job. In fact, if your gross receipts are over $25 million, using PCM is literally legally mandatory.
But watch out, because PCM comes with a really dangerous catch. It's called the profit fade trap. Let's walk through a quick hypothetical so you can completely nail this on the exam. Imagine your estimators say a job is going to cost 100 grand total. You spent 50 grand so far, so your math says, hey, we're exactly 50% done. But what if your estimators messed up? What if the job is actually going to cost $200,000? In reality, you're only 25% done, not 50%. Because you artificially overstated how complete you were early on, you just recorded a phantom profit on your books that doesn't actually exist. And that inevitably leads to a massive, incredibly painful financial write-down later on when reality finally catches up with your bad math.
And finally, Section 4, Mastering the WIP Schedule.
The Work in Progress, or WIP schedule, is the ultimate document. It ties all your job costing and revenue recognition together into one central place. Now I want you to burn this exact acronym into your brain for the exam. CCEB. Say it with me, CSEB. This is the exact calculation order you've got to follow to build a WIP schedule. First up, C, contract amount. What did you agree to get paid? Second, C, cost to date. What have you actually spent out of pocket so far? Third, E, earned revenue. Based on those costs, what revenue have you actually truly earned? And fourth, B, billed to date. What have you currently invoiced the client for? CCEB, CSEB.
Let's actually put CCEB into action and walk through the math. Imagine we've got a $1 million contract. So, step 1, contract amount is $1 million. Step 2, let's say your costs to date are $650,000 and your totally estimated cost for the whole job is $900,000. If we take those costs to date and divide them by the total estimated cost, boom, we find out the project is exactly 72.2% complete. Now, we take that 72.2% and multiply it by our $1 million contract amount. That gives us, step 3, an earned revenue of $722,222. But look closely at step 4. We've only billed $700,000 to date.
So in that example we just did, we actually earned more than we billed. But you know the exam is going to throw a trick question at you. What happens if we flip that scenario? What happens if your billed amount actually ends up being higher than your earned revenue?
I want you to memorize this exact phrase. If you bill more than you earn, you're over the line. Meaning you have an overbilling. You've actively invoiced the owner for more work than you've actually completed on the job site. Now, why is this such a big deal for the exam? Well, in accounting terms, an overbilling has to be treated as a strict liability on your balance sheet. Why a liability? Because, frankly, you are holding the owner's cash for work you haven't actually done yet. If the whole job shut down completely tomorrow, you'd legally owe them a refund, or you'd owe them the free labor to finish it. Either way, it's a debt on your books.
As we wrap up this explainer, I really want to leave you with this foundational thought. A contractor wouldn't ever try to build a house without a blueprint, right? Well, you absolutely cannot build a solvent business without financial statements. These concepts we just covered, the core statements, the ratios, the revenue methods, they aren't just annoying, arbitrary formulas you memorize just to get your license. They're the real practical tools you're going to use every single day to keep the doors open and to make sure your crews get paid.
So, the ultimate question is this. Now that you've got the equations, you've got the memory hacks, and you know the strict rules of the WIP schedule, is your financial blueprint solid enough to stand up to that massive 32% exam weight? Keep reviewing these concepts, trust the process we just laid out, and I promise you, you are going to be completely ready to crush it. See you next time.